as according to as we would believe, the Western spin, I mean, it's as if the BRICS Summit never happened. Yet, under the covers, the gateway to tokenize and financialize trillions of real-world assets has opened. Let's dig into the question, because this ultimately leads to a consensus of liquidity providers pricing gold at a fair value at $8,000. We discussed it last time. And as we recently indicated, silver well into the 3 digits. Now, while this gateway opens up every single commodity to be traded and settled intra-BRICS national currencies, we've been focusing on the West's underestimation of the BRICS nations' ability to actually take full control of the gold-silver price-setting mechanisms, and how, through the formalizing of the financial infrastructure to support a sufficiently liquid global settlement process, the CME, LBMA will increasingly become price takers, not price makers. And this is happening under our noses. And we will see, as we'll see, this is actually central bank driven. And so, responding to Trump's warning to the BRICS so-called war on the dollar, let's start by looking at what Russian Foreign Affairs Minister Sergei Ryabkov reiterated yesterday. And basically he said, no one in the BRICS community is raising the issue of replacing the dollar. The alternative is to switch to settlements in national currencies. That's the path we're taking with BRICS. So really, you've got two different views here. Now, what's being missed by the dollar hegemons? It's not an attack on the dollar. It just means that intra-BRICS trades will be cleared outside of the dollar. Now, Western-facing commodity traders will continue, these trades will continue to be settled in dollars because they face the West. But, and a very, very big but, the price will be influenced by the BRICS nations' physically determined supply-demand prices. And this will be most evident in the real supply-demand pricing of commodities that are also crossed against global-facing foreign exchange markets, of which gold, silver, platinum, and palladium are crossed against. Obviously, not all commodities. In fact, no commodities other than gold, silver, platinum, and palladium are actually crossed seen as money, as a foreign exchange cross against the dollar and the euro, yen, etc., etc. Now, the BRICS multipolar global price discovery process is not just contained to the foreign exchange crosses in gold, silver, platinum, and palladium. In aggregate, including oil, energy, and rare earths, the BRICS nations are estimated to produce, consume, and ultimately control some 85% of an 8 trillion a year global commodities complex. Now, along with precious metals, as we are going to see, BRICS nations are going to become the price makers, not just in the precious metals complex, but also in every single commodity they touch, utilizing the trustless blockchain rails, the tokenization, financialization, and a 7-second settlement process will ultimately dictate a truly multipolar price. Clearly, this is going to backwash into the leveraged, asymmetrically imbalanced derivative markets, which gear around all of these products. Now, what we're going to expand on from our last episode is how, beginning with gold, silver, and all monetary assets, every single real-world asset is in the process of being tokenized and financialized to trade and be settled outside the weaponized dollar-based system. And as we drew attention to during the BRICS Summit, backed by central banks, sovereign, and fresh safe haven physical demand, we have Singapore, Shanghai, Hong Kong, Saudi, Brazil, Africa, Southeast Asia, they've already aggregated sufficient physical market liquidity to actually benchmark a global physically determined supply-demand gold price. Now, following the BRICS Rio Summit and Trump doubling down on tariff threats, the gloves have now come off. Now, in keeping with the overall BRICS mandate of taking barriers down, really to empower multipolarity, the focus on the Rio BRICS Summit was on providing, this is the key thing, the necessary financial multipolarity to be able to price and sanction-proof commodities into a blend of BRICS local currencies. Now, completely missed by the mainstream media and the Western observers is that the complex task of benchmarking trillions of non-dollar denominated intra-BRICS trade will be benchmarked by pegging this blend of widely varying national currencies to a prescribed weight of gold. Now, as we've looked at last time, this de-dollarizing effort is actually being facilitated with the expansion of the new development bank, the NDB, bolstering inter-BRICS national currency trades, ultimately benchmarked to gold, a percentage of gold. Now, Russian Finance Minister Anton Siluanov confirmed that the NDB had formalized a multi-billion-dollar sanctioned tariff-proofed cross-border settlement hub backed up by loan guarantees for mega infrastructure projects across the BRICS sphere. Now, we put up some links on these initiatives last time, but in short, with over 80% of the world's population gaining economic weight and already controlling 40% of all global trades, Trump's tariffs are nothing short of war measures into which the BRICS nations are countering to rapidly consolidate resources. Now, the NDB are consolidating with supporting Chinese initiatives as well. And this is not just a soulless operation. This is really well put together. And so they understand that the provision of the necessary financing is required to bring this forward. And there are a lot of instruments under this initiative, but gold as money will benchmark all local currencies. Now, while everyday current BRICS Pay transactions are currently not directly backed by a weight of gold, because they are settled within the BRICS clear system, the FX value of each nation's currency is actually being weighted against each other by the percentage of gold backing up that individual currency. Hence, the race by every BRICS central bank to accrue as much gold as possible. And much of these gold purchases escape reporting. And while we've been tracking direct central bank purchases for a heck of a long time, some of these transactions have been acknowledged by the World Gold Council in this report. So in essence, 19 out of 36 respondents in the World Gold Council survey said they're buying gold directly from domestic artisanal and small-scale gold miners in local currencies. Okay, so you need a facility for that. 4 are thinking of following suit as well. Now, this is a slightly higher figure than last year's survey, there was about 14 central banks out of 57 said they were buying directly from domestic sources. What does this do? It leaves the LBMA cartel of market makers out in the cold. Furthermore, as we've been tracking ever since the IMF refused China's offer to buy its share of the 400 tons of IMF gold. Remember, that was back in 2010. And you remember that they put up 400 tons of gold for sale. India was allowed to take half, 200 tons. But Beijing's bid to take the remaining 200 tons at the current price was then about $1,000, was absolutely blatantly refused. So China went on the offensive against the West. That was really the pivotal moment where China moved in against the West. And as we tracked at the time, that remaining 200 tons was sold into the market as part of the 50-year gold capping mandate. In other words, we saw time and time and time again over the years, gold being sold into the marketplace or leased into the marketplace. So this was a way of continuing that game. Now, it's no coincidence, though, that this was when China pushed back at the West by opening its gold market to its citizens. Do you remember there was billboards the size of houses put up, TV adverts, go buy gold? Now, it astounded a lot of people because no one had ever seen a government do that before. So now, around $2,500 higher, this process has continued in layers. And at over 31,000 tons, Chinese citizens own by far the largest private holdings of any country on record, even more than officially held Indian citizens' declared holdings. Now, obviously, the Reserve Bank of India does not know the true extent of the thousands of years and thousands of tons of dowries and gift accumulations. But needless to say, even accepting the declared holdings, just these two BRICS members alone have around 10 times as much treasure as US Treasury stocks contain. So, it's important to kind of put this into perspective. So ultimately, with gold increasingly backing real world assets, the US administration has two choices: head into a losing head-on battle against the global majority, or revalue gold to compete. Well, it's pretty clear they're going to have to take the latter option. China stepped up the gold buying ante in February. If you remember, in February, they mandated Chinese insurance companies to divest billions of US treasuries and dollars into backing 1% of their 43 billion of pension assets into gold. A process that has only just really begun and on its own would have been sufficient to drive the gold price above 4,500 by the fourth quarter. But we've got reliable information that this percentage increased to 2% in June, which equates to over 25% of all global mine supply. And word is this is ultimately going to rise to 10% or 4.3 billion in 2026. Now, it's no coincidence that the very large unreported 400-ounce monetary central bank purchases have consistently flowed out of London, out of Switzerland and Dubai hubs over the last 15 years, enabling tens of thousands of tons of gold to be secretly accumulated. And as we've discussed last time, a very large percentage of Beijing's gold reserves, what they do is bolster military assets. And as such, real gold assets are as closely guarded a secret as weapon systems and strategies. So this odd 2,900 tons they talk about is window dressing. This is why official reserves do not include unreported BRICS, primarily Russian, Chinese, and Saudi, 400-ounce monetary gold accumulations, which also picked up significantly in March 2022. Not including what is secretly held by the Chinese generals, empirical evidence suggests that in aggregate, including this 2,292 tons of officially reported gold, Beijing has salted at least 35,000 tons of gold inside the state-held banks. And this is why we drew attention to the probability that into the very real threat of a US-China South Seas China-Taiwan war, should Beijing need to actually bolster their gold reserves, as we saw in the trial ballooned 2023, we covered this in an episode back then, where they trial ballooned Chinese citizens' gold could be, as we say, patriotically leased into the state as part of the war effort, with the PBOC assurances it would be equitably returned at a higher price. And as such, in time of war, Chinese physical reserves could easily exceed over 70,000 tons. So I'm just trying to give an idea of the scale here. As these gold assets as they're tokenized and provide real money backing to real world assets to be traded in real time into tariff sanction proofed 7-second settlement process, the process of wresting control of the gold, silver, platinum, and palladium FX markets from the LBMA cartel is already underway, enabling the BRICS nations to take control of the lion's share of all the commodities they control. And while this de-dollarizing process has been progressed by stealth, Trump's tariff sanction threats equals a declaration of war and has significantly accelerated the process. Now, one only has to look at the charts, really, of the two LBMA CME market makers acting for the Fed. They still enjoy sufficient COMEX position concentration, which is the key. Is that's how they can act as a cartel, because they have the massive position that can be, when you have a position concentration in any market, then obviously you can move stuff around. And they can collusively set up regular end of month wash and rinse cycles. And we saw another attempt today. But these synthetic efforts are notably muted. And quite simply, there's insufficient leveraged Western speculators left to be sucked into the COMEX meat grinder to maintain this 50-year synthetic gold price suppression machine. Underpriced, unallocated COMEX gold is being targeted by increasingly liquid BRICS-centric physical exchanges. Now, because the BRICS gold price benchmarks a true physically settled, and this is the key, globally fungible, Basel III compliant, first tier, high quality liquid asset price, gold anywhere around the world is physical gold, anywhere around the world is immediately fungible across the globe at the price, the global price. So that's going to impact this settlement occurring outside the LBMA is going to really backwash into the local London gold fixes, which also have to be Basel III compliant at the moment of the fix. Now, BRICS determined physically settled prices are increasingly washing back into these diluted local London price fixes, sucking in underpriced COMEX exchange for physicals. You remember we've got that back door at the COMEX where there is the ability to take a COMEX price and shove it into London, and then it becomes T+1 deliverable. There are big shortfalls occurring, and we're seeing some big exchange for physical spreads to short cover.